China's consumer market is worth $7 trillion. That number has been dangled in front of Western boardrooms for 3 decades like a golden ticket. And for a while it worked. Western brands arrived, set up shop, and watched the money flow. Premium pricing, aspirational branding, a logo that meant something. It was enough. It isn't anymore. Starbucks, which once defined coffee culture in China, now has 3,500 stores. Luckin Coffee has 26,000. Samsung held 20% of China's smartphone market a decade ago. Today it's under 1%. These aren't blips. They're the market sending a very clear message. The era of the Western brand as a status symbol is over. Chinese consumers have moved on, and the brands that didn't notice are paying a steep price. This is the story of what went wrong, what went right, and the surprising new survival strategy that's reshaping how global companies operate in the world's most competitive market. In 2019, Burberry launched a Lunar New Year campaign. It featured a somber, unsmiling family gathered in a dark setting. The creative team thought it looked editorial. Chinese consumers thought it looked like a funeral. The backlash was immediate and brutal. That same year, Prada released a Shanghai-inspired collection campaign so tonally off that commenters compared it to a horror film. D&G had already torched its entire China business the year before, with an ad that managed to be both condescending and offensive simultaneously. The pattern here isn't bad luck, it's a structural failure of understanding. Western brands consistently treated China as a single, uniform market. One big audience that could be reached with a translated tagline and a red color palette. But China has 56 ethnic groups, distinct regional identities, and a consumer class that is deeply aware of when it's being pandered to versus genuinely respected. The brands that stumbled weren't necessarily careless. Many had large teams in China. The problem was that decision-making power remained in London, Milan, or New York, with people who had never lived the culture they were trying to sell to. Starbucks built its China identity around the concept of the third place, a premium, unhurried space between home and work. It was a compelling idea, and for years it worked. Then Luckin Coffee arrived with a completely different thesis. Chinese consumers don't want to sit. They want to order on their phone, pick up in 2 minutes, and move on. Luckin scaled from 0 to 26,000 stores in roughly 6 years. Starbucks has 3,500. That gap isn't a coffee story, it's a speed story. China's digital infrastructure enables a pace of iteration that most Western companies simply aren't built for. New product launches happen in weeks, not quarters. Pricing is tested in real time. Consumer feedback loops can close overnight, and the commerce layer is unlike anything in the West. China's live stream commerce market is valued at over $1 trillion. Consumers on Douyin and WeChat don't browse. They watch, engage, and buy in a single session. An influencer can move 100,000 units in an evening. Western brands built for catalog shopping and seasonal campaigns are structurally mismatched to this environment. The gap isn't just technological, it's philosophical. Chinese competitors treat speed as a competitive advantage. Western brands still treat it as a risk to manage. Not every Western brand got it wrong. IKEA is perhaps the most instructive success story. Not because they had a brilliant marketing campaign, but because they did something far more difficult. They genuinely changed. IKEA's China showrooms were redesigned to reflect how Chinese families actually live. They accounted for smaller apartments, multi-generational households, and different storage priorities. The displays weren't aspirational Swedish lifestyle fantasies. They were recognizable. Customers walked in and saw their own homes reflected back at them, just better organized. The cafeteria menu was adapted to include local dishes alongside the Swedish meatballs. And in an outcome nobody planned for, IKEA's Shanghai stores became popular gathering spots for elderly residents. Some used the cafeterias as informal social clubs. others as meeting points for a generation of older singles. IKEA didn't chase that demographic. They earned it by making the space genuinely welcoming. The distinction between IKEA and the brands that failed isn't budget or brand equity. It's the difference between localization as a marketing exercise and localization as an operating principle. One is cosmetic, the other is structural. And in China, consumers can tell the difference immediately. There's a new playbook emerging, and it's quietly reshaping how Western companies think about China. Rather than doubling down on direct control, some of the biggest names in global business are doing something that would have been unthinkable a decade ago: handing operational authority to local partners. Starbucks recently sold a 60% majority stake in its China operations to Boyu Capital, a Chinese private equity firm with deep government and consumer market connections. The deal valued the China business at $4 billion. Burger King went further, selling 83% of its China operations to CPE Capital for $350 million. The logic is straightforward. Local PE firms bring something no Western headquarters can replicate: genuine market fluency. They understand the regulatory environment, the digital platforms, the regional consumer differences, and critically, how to move fast. The Western brand retains its name, its standards, and a revenue stream. The local partner runs the business. This is a significant shift in thinking. For years, Western companies treated China as a subsidiary, a market to be managed from afar. The PE pivot acknowledges something more honest: that China requires a different kind of leadership, and that admitting that is not weakness, it's strategy. If this kind of analysis is useful to you, subscribing to Business Undercurrent means you won't miss the next one. What this story ultimately comes down to is a question of respect. This is not the performative kind, but the kind that shows up in decisions. It appears in whether you hire local leadership with real authority. It is reflected in whether you adapt your product or just your packaging. It is demonstrated in whether you build for how people actually live, or how you imagine they do. The Chinese consumer in 2026 is not impressed by heritage or legacy. They're impressed by relevance, by speed, by brands that feel like they belong in their world, rather than brands that arrived expecting a welcome party. The companies navigating this well, like IKEA and the brands embracing local PE partnerships, share a common trait. They stopped trying to win China on Western terms. They started asking what winning on Chinese terms actually looks like. That's a harder question to answer, but it's the only one worth asking. $7 trillion is not a prize waiting to be claimed. It's a standard waiting to be met. The brands that understand that distinction are the ones still standing. Thanks for watching. If this gave you something to think about, hit like and subscribe to Business Undercurrent. We'll keep digging into the stories that don't make the front page but shape everything underneath it.